Hi everyone, this is Neha Vashisht from ET Markets. Welcome to another episode of ET Smart Investor, a show where we discuss about everything related to your investments and more. Today we have Arun Kumar with me, a VP and Head of Research at Funds India. So thank you so much for joining us on ET Markets live stream, Arun.
Hi, Neha. Thank you so much for having me on the show.
Well, the pleasure is all mine. And for the audience, today we're going to talk about short term mutual funds. So, without any further ado, let's start with the basics. What are short term mutual funds and how do they exactly work?
In a sense, there's no particular category called short-term mutual fund. Where there's a category in debt mutual funds which is called short-term debt mutual fund. But broadly, the idea is for somebody looking at mutual funds and trying to position it for short-term. First level is what is short-term, right? Now, obviously, there's no fixed definition, but generally, anything less than 5 years is a good enough definition which most people have. Now, why do we need this short-term, long-term? Is because the asset class which gives you probably the highest potential for returns is equities. But again, it goes while it goes up, it's fine. But for all that, there's almost a 10-20% fall every year, and like once every 7-10 years you also have a 50-60% fall. Now unfortunately, if you, let's say, only have 3 years, and the worst case in the third year there is a large fall, then you don't have enough time to recover. So which is why you say equities, you have longer time frame. And let's say if you have 10-year time frame, you plan it in such a way that by 7-8 years you reach your goal. And worst case, if you get hit by a large market fall in the seventh, 8th year, you still have another 2 more years to recover. So that's the idea of why the whole time frames came into being. So the first logic is anything less than 5 years can be considered to be short term. And what you can't do in a short term time frame of 5 years is you can't have too much of equities. In fact, if you can avoid it, is great. But again, within 5 years, you are leaving a lot to luck. Because let's say if you have 3 years, you invest in equity fund. If you're lucky, you might get great returns. But let's say worst case, that third year you get hit by a large market fall, but you need to take out the money. You will have to take it out at losses. So which is why for equities, probably the odds of having a good experience is very low when you have a shorter time frame. So now the next question is, so what kind of mutual fund categories or products do I use for the short term? One is a very simple debt mutual fund. And again, within debt mutual funds, you can simplify it saying that I will probably stick to short term debt mutual funds, which generally invest between the 1 to 3 year debt papers. Or if you want it to be even more conservative, there are categories called low duration funds, or one level below would be money market funds. So these are the three categories that you can use from the debt mutual fund space if you want to look at short term investments. And as an alternate, you can also use, if for people at higher tax brackets, you can use a category called arbitrage mutual funds. They almost have returns similar to liquid funds over 6 month period. Then the question is, where shouldn't I go only for liquid funds? Why unnecessarily complicate my life? But this has a taxation advantage, because this arbitrage funds, though the return profile is very similar to liquid funds over 6 month time frames, it is taxed like equity. So which means after a year, you get for up to 1 lakh there is no tax, and above that it's only 10% tax. And let's say if you are in the higher tax bracket of 30%, this might make a big difference, right? So arbitrage can be the second category that you can consider for your short term goals. The third is if you have slightly, say, between it's not short enough that it's not less than 3, but let's say you have 3 to 5 years, and it's a goal which you can slightly elongate if required. Let's say you are saving up for a car. Worst case, even if there is some temporary decline at that juncture, it is, you can still postpone it by, say, another 6 months, 1 year, 1.5 years. So these are not very fixed goals. So in those cases, you can take slight equity risk. And there are products like equity savings funds which will automatically give you 20 to 40% equity exposure. Or there are also products called as balanced advantage funds, where the equity allocation automatically moves between roughly between 30 to 80%. Now, different mutual funds will have a different band, but mostly majority of the industry funds will move between the 30% to 80% band. So this can be the second choice. In this case, they will automatically keep moving up and down. usually in a 3 to 5 year time frame, you end up with very good returns for both these equity savings and balance advantage fund. But in the worst case, in the, let's say in the third or fourth year, you get hit by a large fall, like we say the COVID fall happens, then you will need to extend it by 1 year. So that's the requirement. So broadly, anything less than 3 years, you can look at short-term debt mutual funds, you can look at low duration funds, you can look at money market funds. These three are more than enough. And then you can also look at arbitrage funds if you want that taxation advantage of equity, especially if you have 1 year or more. You can also consider arbitrage funds and compare the returns, post-tax returns, and see if it makes sense to you. This is for the less than 3, and for 3 to 5, equity savings fund is one category, and balanced advantage fund is the second category.
Okay. And if we talk about the durations, we've also heard that there are mutual funds that are maybe like 3 months, 6 months, and so on. So I want to understand what are the different durations that are available in the market for short-term mutual funds, apart from 3 year and above that.
Yeah. So if you are coming to less than 1 year, so there are different categories which are prescribed by SEBI, which basically puts the boundary condition saying, hey, for these debt funds, you are only allowed to invest in this maturity securities. So let's say you take the liquid funds or you take the overnight funds. If you have a time frame of only 1 month, say you are just parking you got your salary, and probably in 10 days you are planning to buy something, so you temporarily want to park it. It's more like, think about it more like your savings bank, but probably it will give you much higher than savings bank account. So usually you will find the large corporates, they will park it temporarily here. Let's say an organization is going to pay the entire salary, and let's say there is 2 more days to pay. So even for that 1 or 2 days, at a large base, you will make slightly higher returns, right? So this is a temporary parking vehicle which can be used by either individuals or by corporates, and mostly corporates use it on a regular basis. So this is a category is called overnight or liquid funds, supremely safe, primarily meant for putting money temporarily, making slightly better than your savings bank account returns, and then taking out money whenever you want. So overnight and liquid funds for anything less than 1 month. Say if you have anything coming up between 1 to 3 months, there's one more category called ultra short-term fund, which is slightly possibly might give you slightly better returns than liquid funds, and they are allowed to invest in the maturities up to 3 months. So you can look at ultra short-term funds. Anything more than 3 months up to 1 year, broadly you have the low duration funds as one category which you can use, and then two, you also have the money market funds as the second category. Now obviously there are other different categories like floater and all that, but again, you're unnecessarily complicating life. So my sense is you can so anything less than 1 month, just pick a liquid fund or an overnight fund. Anything between 1 to 3 months, just pick an ultra short term fund. And anything more than 3 months, you can look at money market funds, or you can look at low duration funds. I think this is broadly good enough for somebody to plan for the next 1 year. And if you have 1 year or more, you can also look at arbitrage. Ideally, 6 months is more than enough for an arbitrage fund. But again, after 1 year, only the taxation advantage starts to kick in. Because otherwise, I mean, this is also applicable only if you are in the highest tax bracket. Otherwise, I think you can keep it as simple as only use debt mutual funds. But if you are in the higher tax bracket, if you have 1 year or more, say you need from 1 to 2 years, then you can also check out what is the arbitrage expected returns, and then reverse work the post tax returns, and then compare it with debt, and then see does it make sense to look at this category. So I think this is broadly more than enough for you to plan for your short term requirements.
All right. Also wanted to clarify one more thing before we go to the returns, that do short-term mutual funds only have debt part in it, or they have slightly a little bit of equity also included?
So all the categories which I had mentioned for the less than 1 year is purely only debt. If you want some bit of equities, as I told, you will need at least a 3 to 5 year kind of a time frame.
Hmm.
So two categories come in: equity savings, which will have 20% to 40% into equities, and balance advantage funds, which will right now most of them are at say 40 50%. Sometimes if let's say markets correct, they might bring it as high as 70, 75, 80%. And again, when markets become expensive, they can bring it down as close to 30%. So this is a dynamic category, but broadly on a 3 to 5 year basis, this category tends to do well. Slightly more risk than the equity savings category. So the way you can look at it is, if you want some equities, the starting point can be an equity savings category, and the second level, if you want slightly more risk, then you can go for the balanced advantage fund. Yeah, the advantage is that both of these are equity taxed. So which means after a year, you get the equity. I mean, you get equity taxation even within the year. But after the year, you get that up to 1 lakh. You have you don't need to pay taxes, and then it is only 10%. So within a year, you'll have to pay roughly 15% tax. But net, it for the higher tax bracket payers, this makes a lot of sense, especially if you have a 3 to 5 year time frame. The key thing to remember is that it is not it's not like it won't have a fall. Just to put in a context, balance advantage funds were almost down 20-25% when equity markets were down 40%, while debt funds were hardly fell. So this will fall, which is why I said if at all you are unlucky that the third year, fourth year when you wanted the money it falls, you should be mentally okay to have the bandwidth to extend it by 1 to 2 years, but then it again recovers. So the key point is if you only have that flexibility, you can look at these two categories. But these are the two categories which will give you equity exposure.
All right. And what about the returns? What kind of returns do we generally get in short-term mutual funds?
Yeah. So broadly in short-term mutual funds, the primary intent is to kind of beat the inflation. So if you look at short-term debt mutual funds or low duration funds, broadly you will get inflation plus say around 1.5% is the broad expectation. Or the other way to think about it is like usually for the similar tenure of FDs that you're looking for, you should generally end up making 0.5% to 1.5% more. Generally keep the expectation as FDs plus 0.5%. And sometimes when interest rates are falling, debt mutual funds end up getting an advantage. So you might get a slightly higher returns over and above an FD. But over a cycle, I think roughly FD plus 1% plus or minus 0.5% should be your expectation for this category. Let's say if you're getting in slight equity exposure, then it should be FD plus 2 to 3% should be your expectation over a 5 year cycle. Now, again, like these are not precise numbers, but at least you should go in with it, because otherwise there's no point of taking 30% or 20 to 40% equity, right? You at least need a 2% plus kind of returns over an FD. But historically, you almost most often than not, you've crossed this threshold. In rare times when there is a large fall and it is yet to recover, and then to measure 3 year, 4 year returns, it might be slightly lower. But again, we have seen that you extend it by 1 year, again the returns tend to sharply come back because markets inevitably recover. So the way you measure will also matter, because if you're measuring when equity markets are down, obviously this return expectation you might be disappointed. So you have to mentally be that I will measure it after 3 to 5 years, and in a period where the markets are not say down by 10, 15, down by not more than 15%, then mostly the expectation of FD plus 2% should get satisfied. So these are rough, broad metrics, assuming the underlying, because debt mutual funds more or less end up very similar to FD plus, as I told you, right? FD
Yeah.
plus 1% plus or minus 0.5%. Then you add some equity, so net that pushes up the return to that 2 to 3% band. So this would be the broad return expectation that somebody should have when they look at these categories.
All right. So before we move ahead, I just want to tell the audience that if they have any questions related to short-term mutual funds, they can ask Arun in the comments, and we will try to take the questions towards the end of our segment. And another request that please keep the questions related to the topic of the day, not related to separate stocks. So, going ahead, Arun, I wanted to know that what about historical returns? So, whenever we invest in anything, whether it's a short-term thing or a long-term thing, we want to understand how the product has performed historically. So, what are your thoughts on its historical performance?
See, historically for debt mutual funds, at least you've made returns close to that 7 to 8% has been the 7% is a decent number in terms of history, because again it's a derivative of the inflation. The inflation numbers
Hmm.
were reasonably high in the past for a long period of time, but again in the last
Yeah.
5 6 years the inflation numbers have also started to come down. So I think unlike other categories where you can broadly look at the past and then get a sense of
Come to
what
a
kind of
yeah.
returns that you might have, debt mutual funds are not a category where you probably look at history and then say, hey, this fund has given me say 8%, so will I get. So the
It's
key
more or
point,
less the same.
yeah. So the key point is that whenever you're investing in debt funds, the first number that you'll have to look at something called the YTM. YTM, see, in debt funds, what you're essentially doing is that you are lending your money to some company
Hmm.
or the government. Now, if you have to do it, then it's very tedious, and hence because you don't know which company to lend to. What if that
Yeah.
company defaults and doesn't pay me the money? So debt mutual funds
Hmm.
basically come in between and then say, hey guys, you give me all the money, I will figure out whom to lend, and whatever they are giving as interest rate, I'll pass it on to you, and that's how you make returns in debt, right? So net, it is the borrowing rate. Somebody is borrowing from you. You are almost like a money lender without telling that you are a money lender, right? So if you are in a debt fund, the first thing you need to ask is, hey, my money is being lent to so many companies, some government organization or the government itself, which is called the G-Secs and all that. But broadly, you can assume that your money is getting lent. The first question that we'll ask is, what is the interest rate that I am getting at an aggregate level? That number is technically called YTM, which is yield to maturity. So in all your funds, you will get that YTM number available. So find out
Yeah.
what is your YTM. Roughly for most funds, it will be roughly around the 7% at the current level. Maybe 1.5 2 years back, it was as low as say 4.5 5% for a lot of funds. But this number keeps moving based on the current interest rate. Just like how we were able to borrow home loans at 7% 2 years back, now it is available at 9.5, right? Because as interest rates move, the rates that we pay to borrow is also increasing or decreasing. Same thing applies to us because we are lending based on the interest rate. Whoever is borrowing also will pay us higher or lower based on the current prevailing rates. So let's say the prevailing rate is at 7%. So then you need to know that 7% is what I will get. But again, these mutual funds will also charge you some expense, right? Because they are not doing it for
Yeah.
free. So that will come as expense ratio of say 0.2%, 0.3%. So what you have to do is say you are at 7.3 is your YTM, 0.3 is the expense, you subtract that, you will roughly get 7%. So your expectation when you get in should be that, hey, broadly over the next 1 year, as long as these YTMs don't move drastically up or down, I should roughly get around that 7%. Now the second component in debt mutual funds is that as interest rates go up or down, you will also get if interest rates go up, you will get a slight kicker in your returns, and if interest rates go up, you will get a slight detractor in your returns. So mostly at the current juncture, looks like interest rates will eventually start going down in the next 1 2 years because inflation globally is coming down, the growth is slowing down, and RBI is also been pausing. So worst case, even if it doesn't go down, you are still not, the risk of it going up higher is very very minuscule. So mostly you might also get this additional kicker when the interest rates start to fall. Now that will depend on the modified duration of the fund, or in rough ways, like how long are you lending your money for. If you're lending it out for a longer duration, then you get a higher impact, either positive or negative, based on how interest rates are moving. Now if our expectation is that interest rates will go down, so which means you will get a higher kicker in your return. So broadly, check the YTM minus expense ratio. This is the first part. Second is check the modified duration. Modified duration, if it is anything less than 3, is a safe number. But if you want to take a call saying, I know for sure that it will go down and I want to increase my modified duration, because modified duration will effectively multiply your impact. So let's say interest rates go down by 1% and you're running a modified duration of 5, it'll do 5 times your 1%. So which means you will immediately get a kicker of 5%. Let's say modified duration is only 3, you will get a 3% kicker. Now you might say, why don't I go 10? The problem is if interest rates go up, you straight away get a minus 10%. So which is why you will
Yeah.
find that the long duration funds will also have negative returns at some point in time if interest rates go up. So broadly, look at the YTM minus expense ratio to set the expectation, and just take a call on keep the modified duration to less than 3 years, so that even if interest rates go up or down over a 3 year cycle, the effect kind of gets nullified away. And if interest rates are going down, for that 1 2 year period, you will get benefited by, instead of 7, probably you'll end up at 8 or 9. So that's how this works. So don't go by the past returns, unlike other categories, because that will completely miss.
And as you mentioned, that the whole point of investing in short-term mutual funds is mostly beating inflation and not getting returns like we expect in
Right,
equity. So I think it
right.
goes in alignment with that. So, lastly, just to conclude the session and before we take the questions, I want to understand who is the ideal investor for short-term mutual funds.
See, one is, again, if you have any particular short-term goal coming up, say you want to buy a car, or you're planning for a small vacation, or you plan
Hmm.
for a down payment for a house, and mostly these are our school fees, or something which is not too small an amount, say probably 5 months of your salary or more, which is reasonably large enough that you might have to start planning much ahead of time. But it's also coming up in the next 3 to 5 years, where you really can't focus on improving the returns, because you just don't have the required time or the flexibility to extend it to a longer time frame. So this will be one category which can use the short term I mean, the categories which are used for short term funds. And then the second is, you overall have an asset allocation. So which means that out of 100 rupees you have, you're not putting everything into equity, because then your portfolio will become very volatile. So you're, say, only putting 70 rupees into equity. The remaining 30 you can put into these kind of products, which are debt funds, or arbitrage funds, or equity savings fund, or the balance advantage funds, because this will kind of nullify the volatility profile of your equity. But again, this will get a slightly lower return. And the third category is people who like to keep this as a parking lot. Say the same 30% they keep it here, but when there is a large market fall, they might want to use this money and then deploy it back again into equity. So that is something like, you keep 70% at all points in time in equity, but this 30 you will use it only during a large market fall. So there are people who do these kind of so there are multiple use cases for how you can use these short term related mutual funds.
Yeah, and I think it's good for people who just don't want to invest in riskier asset
Yeah,
classes.
yeah.
And also, if your money is just lying idle, then you are not earning anything out of it. And
Right, right,
same thing that you're not beating inflation, you're not getting anything. So why waste that, duration? And
right,
it's better to get a return. Chai, it's smaller in a number, but you are getting some kind of return. So I think
right,
it's the
right,
same with the RDs and FDs, but just a
right.
little bit different.
Right, right. So if you're a typical FD investor, maybe you might want to, and let's say you have a very large amount. Let's say you might want to attempt, or at least understand this, especially in times when interest rates are coming down. You get a higher benefit from debt mutual funds, and those categories where you get a little bit of equities and the equity taxation. So that can work well for you, both on the taxation front and on the return front. Especially if you are an FD investor with, say, a lot of people don't have a particular time frame, like they just keep
Hmm.
extending their FDs for a long period, so it
Yeah.
effectively becomes a almost like a long term FD. So if you are somebody
Hmm.
like that, I think this can be a good product for you to experience one level above FD, which is not as volatile as equities. But again, you can start off with a small portion, just get the taste of it, and eventually kind of slowly start building a reasonable portion of your FD portfolio into this, and broadly get a flavor of both of these. And then based on how your experience is, you can eventually take a call on whether you want to continue with FDs, or do these products make a lot more sense.
All right. So now we'll move to the questions from the audience. I'm going to only take questions that are related to our topic of the day, and I'm not taking any questions that are stock specific. So the first question I'm going to take is by Rajat. Rajat is asking about Quant Small Cap Direct Fund. So basically, he's asking that for 3 years, that fund is giving 51%. Is it feasible or something? Is there something I'm missing in the mutual fund? And the same question he's asking for other mutual funds also. So is the mutual fund return will be 30 to 50% in 3 and 5 year, like we see in the applications and everything. When we see 30%, 40%, but we don't get it. Most people don't get it, and then they're like, it was shown, but it's not there. So how does it work?
Right. So 30 to 50% is definitely not achievable.
Not
There will
possible.
be occasions where you get it. Say, let's say somebody invested in the bottom at 2020, then you the next year the markets were up, say almost close to from 37,000. It came up as close as to 60,000. Right. So most funds were anywhere up between 70, 80, even 100%. So sometimes when the base is low, you will find that, and then there will obviously be certain funds which take far more aggressive strategies and are able to outperform by a very larger margin. But again, over long periods of time, your expectation should be that roughly 12% is where the GDP overall growth is expected to be, say around 6% GDP growth and roughly around inflation at 6%. And if you pick good funds and they are able to outperform, then 12 to 15% is a decent expectation to come in. And if you have a 7 to 10 year time frame, mostly you will end up coming close to that, because if you roughly look at the historical numbers, last 23 plus years, we have the data for Nifty 50 total return index. Almost 65% of the times you double in 6 years, and remaining and another 80% of the times you double in 7 years, and like around 80% of the times you triple in 10 years. So the odds are disproportionately by your side, provided you have 7 to 10 year time frame. And this double in 6 years is nothing but 12%. Double in 7 years is nothing but 10%. So I think broadly you come in with a 12% expectation. Now what you're saying is obviously, one, the base is low, and the particular fund is in an extremely risky category. So small caps tend to do, all small caps have done well, and this particular fund has done disproportionately well. But you shouldn't come into this fund with the expectation of these kind of high returns. As I told, the 12% to 15 should be your broad expectation from a flexi cap fund. Small cap should ideally give you slightly better returns than this, but again, it depends on when you are entering, what are the
Entering.
valuations that you are entering, and all that. So that is like a separate topic in itself. But my sense is there's nothing abnormal, but again, you'll have to one check what is the fund strategy. Do you understand it? It has a very high churn strategy, so you have to ask: are the flows coming? Are the flows too high? Can they replicate the strategy at higher levels, at higher AUM size? And do they have a 10-year track record? Because you've only seen the last 3 4 years. How did they manage the downfall? So you need to ask a lot of these questions and not just go by the past returns, because at some point in time all funds will underperform. It's across the world. Even Warren Buffett underperforms regularly. So almost everybody underperforms. The point is, if you don't understand what is happening, then during the underperformance you'll again knock off. So you'll come in now after 2 3 years when every fund, let's say this fund also underperforms at some point in time, you'll take over the money, so you'll get the bad experience. And let's say at some point in time it recovers, you still miss it out. So I think before understanding how this works, and in terms of how much of your entire portfolio goes into this, so you need to design the portfolio in such a way that you have different strategies, and if something is not doing well, something else is compensating for it. So but don't individually go by that 30 50% is for sure. You won't get it over 10-year cycles, unless and until you are exceptionally lucky in one fund, you enter it at really bottom levels and you enter at B. But that should not be your expectation. If you get it,
Hmm.
nothing like it, but come in with a very low expectation so that you get a very good experience.
Right. So the next question I'm taking is by Samir. Samir is asking, what is the difference between short term and liquid funds? Yeah, I also wanted to take up this question that do liquid funds fall under the umbrella of short term mutual funds, or liquid funds is a separate category itself?
So liquid funds again fall under, see, there's no umbrella called short-term funds. It's just that,
Hmm.
again, as I told, you are lending your money out, right? Now,
Hmm.
the question, now first we ask what is the interest rate that I get, which is called the YTM. The next question that you ask is, how long am I lending for? Let's say I'm lending
Yeah.
you, say, 5 lakhs. Now, the next question is, hey, Neha, when will you return the money back? So if you are returning within 1 month, then I don't mind. I will pay. I will charge you something minimal, which is very close to the 1 month. But let's say you're asking me for 10-year money, then I need to be worried, because like you are going to repay me only after 10 years. Now I'm taking a bet on
Hmm.
Neha, over the next 10 years, like, hey, what if in the fifth year you decide not to pay me or you're not? So I need to have a broad view on. So which means for to compensate for that risk, I will charge you a higher interest rates. But then I say, hey, Neha, like 1 month is fine because I reasonably know for sure that you will still be here. But 10 years is a very long bet. I don't know what, I mean, like there'll be 100 things that can happen. So I don't want to trust my money with you for 10 years. And if at all I am doing that, I'm taking a higher risk. So you pay me higher amount. Liquid funds are basically like you give it for close to a month. Overnight funds are you basically do it on a daily basis, right? So which means your interest rates that you get, the borrowing rates for the somebody who is borrowing through the liquid funds is very very minimal because they're only borrowing for 1 month, right? So in effect, your returns will also be lower to that level. But short term funds are you are lending for 1 to 3 years.
Hmm.
So this category definition is that whatever money you give, the debt fund manager in turn will lend it to the companies, but they lend it to for 1 to 3 year papers roughly. Right? So which means you will get slightly better returns from this. So all you have to ask is uh, how long am I lending it for? If I'm lending it for a longer time frame, I'll get a slightly higher interest rates because I'm taking slightly higher risk. Shorter time frame, I'll get so which is why liquid funds you use it for a monthly kind of an if you need the money within 1 month, then you can use one liquid funds as a parking lot. But if you have slightly longer time frames of 1 to 3 years, then you can look at short debt mutual funds as a uh, as a as a uh, as a category to invest in.
All right. Okay, so I'm not going to take any more questions because the rest of the questions are related to stocks and we're going to only talk about short term mutual funds. So, with that, we have reached the end of our segment today. Thank you so much, Arun, for joining us on
Sure.
ET Markets live stream and talking about short term mutual funds.
Sure. Thank you so much.
Thank you. Thank you, everyone.